This is David Ranson. Welcome to our January webcast on a theme, and our theme is multiple signals for a modest uptick in US growth. Economic pessimism is deeply rooted, and yet, climbing a wall of worry, the US stock market advanced 30% in 2019 to new highs. In fact, events are not endorsing either side of this extreme range of sentiment. As it happens, several independent and well-tested indicators are in sync. All suggest that the election year economy will come out somewhere in the middle, growing faster than last year, but not by much. Not for the first time, the forecasting picture is fogged by dozens of overlapping indicators cited by pundits with different points of view. Confusion arises from forecasters' inclination to be swayed by information they feel ought to be important, rather than what is demonstrably predictive. Independent and well-tested ways to explore the near-term future of US growth are not numerous. The best come from two sources: hard data produced by the economy itself, or information or collective opinion gleaned from financial market prices. As we have many times proposed, credit spreads in the investment-grade bond market are the best of the best. These are naturally interpreted as measures of the riskiness of the economic environment, or, alternatively, of the willingness of seasoned investors to bear risk. Divergent yields on Moody's, Baa and AAA classes of corporate bonds have a history of nearly 100 years, during which they developed a record of mapping movements in real GDP up to a year in advance. There's evidence that the Baa yield ratio is more predictive than the basis point spread, but either is an indispensable tool for asset allocation decisions as well as economic forecasting. The first exhibit illustrates. During the past year, the Baa yield has been trading in a range between 27 and 30% above the AAA yield. Exhibit 2 shows it, along with the conventional Baa AAA spread metric, which is shown at monthly intervals. In the months leading up to 2019, both metrics widened moderately and slower growth did follow. But as of early 2020, the economy has enjoyed a year of plain sailing. It's enough of an improvement to imply a small increase in GDP growth this year. The graph's upper bound of 50% indicates roughly how high the Baa AAA ratio would have to get to bring year-over-year growth down to zero, so there's no visible scope at present for either vigorous growth or recession. Financial economists have long been deriving predictive information from interest rate spreads. Most popular of all is the spread between long-term and short-term Treasury securities, the slope of the yield curve. But correlations can come and go, and experience warns that the consistency over time of any such relationship should always be checked out. At an earlier time, when the slope of the curve was a powerful indicator, it served as a measure of the aggressiveness with which the Fed had pushed short-term interest rates up or down. It was never a successful indicator on the basis of bond market behavior alone. Evidence from the past couple of decades suggested that the Fed's interest rate changes no longer shock the markets as they did in the past. The slope of the yield curve deserves much less attention than it is still receiving. The difference between 3-month Treasury bill rates and the overnight federal funds rate is far less known, but happens to be a more reliable predictor. Logically, it indicates the direction and speed with which the Fed is expected to change short-term interest rates in the near term. To the extent that continues to be important information, it's a reason to expect this spread to serve into the future as a leading indicator of economic growth. As far as the past 63 years are concerned, it's easy to confirm a strong relationship between this spread and the forthcoming change in Fed policy. We begin by dividing the history of the annual average spread into 4 groups of years according to whether it was steeply negative, moderately negative, or positive. Exhibit 3 shows the next year change in the Fed funds rate averaged for each group. The relationship is confirmed by a statistically significant correlation of 0.36 between the width of the spread and the following year's change in the federal funds rate. Even when the full period is split into 3 successive 21-year periods, all 3 correlations are significant. The ability of this spread to predict the direction of Fed policy is at least as strong today as it ever was. The second step is to explore the predictive power of the spread for the economy. With respect to real GDP, there is indeed a strong correlation 1 year ahead, about 0.48. This is illustrated by dividing the history of the annual spread by magnitude into 4 groups of years. In Exhibit 4, the following year's GDP growth is averaged for each. When the interval 1955 to date is divided into 3 equal subperiods, the correlation for each separate subperiod is statistically significant. So, in assessing the economic outlook, what we could call the left end of the yield curve, though much less watched than the right end, is more relevant. According to the chart, a zero spread has indicated roughly average economic growth. Changes in the spread in the last couple of years are broadly in sync with what subsequently happened to the growth of real GDP. In the first half of 2018, it became positive, averaging about 12 basis points and correctly suggesting stronger growth ahead. But in early 2019, it slipped into negative territory, anticipating the slowdown that we have experienced. Now, the spread has recently reapproached zero, and this points to slightly increased growth this year. The equity market is the other obvious place to look for a financial market forecast of the economy. Last year's 29 or 30% gain in the S&P price index pushed the equity market community into high optimism about the economy in this election year. Who can refuse to be bullish with numbers like these? But the jump in the first quarter of 2019 merely reflected a bounce from the previous quarter's damage. December 31st is always an arbitrary starting point for recording the performance of any asset, even in long-term comparisons. A better choice of starting date would be earlier, prior to the October and December disturbances, perhaps the end of September. The 15-month price gain in the S&P between that date and year-end 2019 was just 11%. Alternatively, the calendar year average S&P index for 2019 could be compared with the calendar year average for 2018. That gain was only 5.5%. This isn't the only reason why the stock market is not a straightforward indicator of economic growth. Practically everyone interprets the level of stock prices as a measure of economic confidence. That's understandable, but the market is notoriously prone to issuing false alarms of recession. The correlation between year-to-year changes in the S&P 500 and the following year's real GDP, which has been only about 0.4 over the past several decades, has modest statistical significance. Viewing the market as a measure of economic vitality is only half the story. Stock prices are also a gauge of uncertainty or expected market volatility. Strong performance might be a signal of either healthy economic growth or a rebound based on reduced uncertainty, or both. Forecasts of economic growth should allow for 2 separate pieces of stock market information. One is the market's performance, the other is the change in implied volatility. So there may be a missed opportunity here. The annual average VIX index correlates inversely with GDP almost as closely as the market's performance correlates positively. An increase in the VIX index is a warning of economic weakness, as occurred notably in late 2008. But as a leading indicator, VIX is no more straightforward than the stock market's performance. Short-term upsurges and implied volatility are associated with sudden market setbacks, but they quickly subside as the market recovers. Only when an increase in VIX is sustained does it become predictive. Furthermore, the influence of VIX on GDP does not follow a straight line. The unfavorable effect of an increase in VIX is much greater than the favorable effect of a decline. This is clear in the illustration in Exhibit 5. We divide the history of annual percentage changes in the VIX index into quartiles, and then average the following year's real GDP growth in each quartile. So, growth is vulnerable to an increase in VIX, but there's no evidence here that a decline is helpful. The interpretation would be that although increases in uncertainty or investor anxiety are a powerful drag on the economy, there isn't any compensating boost when anxiety subsides. In other words, it seems that the change in VIX has useful predictive power only when it is positive. Even more surprising is evidence that the relationship between stock market returns and subsequent growth is not a straight line either. This nonlinearity is equally easy to demonstrate. We divide the history of year-to-year returns from the S&P 500 into quartiles and then average the following year's real GDP growth in each quartile. Exhibit 6 shows that as with VIX, the link is one-sided. Economic growth responds to above-average stock market performance, but not to below-average performance. This may partly reflect the notorious false alarms sounded by V-shaped stock market plunges, which temporarily depress cumulative performance. So it seems that S&P performance has useful predictive power only when it is above average. We can combine the predictive ability of stock market advances and increases in the VIX index with the aid of another illustration. The best conditions for subsequent growth are a larger than average gain in the market coupled with a decline in VIX. The worst conditions are a decline in the market and an increase in VIX. The results of these two extreme scenarios are shown along with intermediate cases in Exhibit 7. Intermediate conditions, not surprisingly, lead to intermediate results. The relationships shown in the two previous charts can be reduced to a two-faced indicator. Least Square's work over the period 1986 to date produces a formula set out in Exhibit 8. It has a multiple correlation coefficient of 0.68, and both variables are highly significant statistically. Good news for the economy is reflected in a sustained stock market gain, while bad news is reflected in a sustained rise in implied volatility. Notice that the indicator gives no weight to either a stock market decline or a VIX decline, given that they are both unhelpful predictively. Years in which the S&P fails to advance and VIX does not increase are expected to be followed by 2.3% growth. As 2020 begins, the formula confirms the results of the other indicators. Calendar year 2019 experienced a below-average stock market return of 7% from the year before, and a small decline in the VIX index, neither of which counts in the formula. That implies a calendar year gain of 2.3% in real GDP for 2020 relative to 2019. It means an improvement from the 2% growth rate of the last 3 quarters. The last of our indicators derives from hard data drawn from the economy itself. Its existence rises because GDP is neither the earliest nor the broadest measure of economic activity. The market economy consists of a vast number of transactions, and its vitality is measured by the total volume of these transactions, the number of dollars that change hands in market activity. Estimates of the US economy's total market output are known as gross output, or GO, and they deserve far more attention than they get. But since World War II, Washington has held only the final product of the economy worthy of attention, as opposed to the total effort that the market economy makes. The situation would be much clearer if we were to rename GDP more accurately as Gross Domestic Final Product and refer to GO as Gross Total Product. GDP is just a fraction, 55 or 60% of GO. It includes only those transactions in which the purchaser is a final user or consumer. It excludes those in which the purchaser is an intermediate producer. In a nutshell, as Chapman University economist Mark Skousen has pointed out, GDP represents the bottom line performance of the economy, while GO represents the top line. GO and GDP differ importantly in their timing. Earlier stages in the chain of production and distribution obviously take place and generate data earlier than the final stage that characterizes GDP. Transactions occurring in these earlier stages are known collectively as II, intermediate input, or more meaningfully, intermediate output. The average time lag between them becomes visible when we compare correlations between the growth rates of calendar year intermediate output and GDP for subsequent fiscal years. Exhibit 9 shows the skewed shape of the correlation curve. Intermediate output anticipates GDP several quarters into the future, albeit to a diminishing extent, but our estimate of the average lag is a little over 3 months. The most recent figures yet available for GO and intermediate output are for the third quarter of 2019. It's too bad, but we'll have to wait until early April for any more timely information. Comparisons with real GDP over the past several quarters are shown in Exhibit 10. The slight acceleration in real intermediate output in the latest quarter implies a small improvement in real GDP growth in the near future. Altogether, then, we have 3 indicators from the financial markets and 1 from hard data, and all are in close agreement about the 2020 economy. At this stage, I'd like to reintroduce my colleague, David Campbell, who is based in the United Kingdom.
David, you are positive on the outlook for US economic growth this year. Is your perspective compatible with the current picture we see on world trade? World trade volume has fallen year on year in each of the last 6 months.
Restrictions on trade for both exporters and importers are certainly impediments to output and prosperity, but international trade bears only a small ratio to domestic output in the US, much smaller than elsewhere, so an acceleration in US growth this year is compatible even with continuing trade wars.
Without speculating on the future course of the present coronavirus outbreak, what can you say about financial market reactions to such an emergency, based on the 2003 SARS panic?
Not much. Stock markets mainly price economic growth and uncertainty, while bond markets mainly price expected inflation and central bank actions. In the region of origin, a public health emergency may bring economic activity to a temporary halt, but short of a pandemic, it will not register much in world capital markets.
The continental European economy continues to perform poorly. The European Central Bank has failed with past policies to stimulate continental economic activity or to strengthen Eurozone banks. With the ECB's new head expected to sustain the policy stance and maybe invent new green government bonds to buy, what change do you think there will be in European economic prospects? Indeed, David, do you think that the euro itself will survive in the long term?
I think a return to positive interest rates would mitigate depressed growth. Christine Lagarde has an opportunity to observe what outsiders already know about the failure of QE, and she has the power to terminate it, especially if she can find some more popular track on which to launch the ECB. I am pessimistic about the long-run future of both the euro and the European Union itself.
The price of gold is influenced by both short-term anxiety, geopolitical or coronavirus related, and by shifting confidence in the US dollar over the longer term. But how can we confidently understand what driver is dominant at any point?
Unfortunately, we can't. Gold is unique as a monetary safe haven, so there's no way to double-check its message against other haven investments. Over time, the best we can do is recognize which moves in the gold price are sustained and therefore inflationary, and which moves are a temporary divergence from trend. That's the end of our January webcast. I look forward to future webcasts starting in March. Thank you.